Hello, everybody. Jake and Gino here, and today we're discussing 2022. Crazy year. Multifamily especially had a wild ride. So today we're going to take a look back on what was and see what we can learn from it, because ultimately you look back, analyze history, maybe we can make some pivots where we messed up and start to look for a great 2023. Gino, how you doing today?
Doing great, Jake. I've got some notes here. And as you say, it was a crazy year. When hasn't it been a crazy year in the last, I don't know, since the Great
2019
Recession?
2019 seemed kind of okay. I like 2019. 2019 was a good year. Since 2019, it was kind of nutty. But anyway.
What was good? What was a good year about 2019? Let's reflect on that.
You know what I like? You know what I like? I like boring, good, stable growth. We like to keep it boring. I like to let the good times roll. You know, I'm not much for any excitement. I just, because we've all had excitement in our lives, right? Just keep it simple, positive growth, and I'll be a happy camper. But hey, I guess that's not life.
So that's why you hate 2022, because in the beginning of 2022, the first few months before they decided to become adults and raise interest rates, which they should have done probably a year sooner, deals were being bought on bridge debt. This is stabilized deals that people were buying on bridge debt. And it doesn't get any crazier than that. If you think about it, now rates have shot up. That's been adding some turbulence to the market. I think prices need to be readjusted. But Jake talked about stable growth. In 2021, rent growth was up 17.6%. It slowed in 2022, only up 4.7%. But we're seeing the deceleration now in Q3 and Q4 of 2022. So for any of you out there that underwrote 17% rent growth for the next 5 years, you're in trouble.
But that's bullshit, Gino, because we saw underwriting from groups that were basically underwriting for 20% rent growth year for I don't know how long. It's like, guys, what is sustainable? Like, that was insane. And if you'd pick out a joke at it, like, people would be like, no, that's what it is. Like, oh, okay.
And
Jake,
what about your thing with talking about short-term debt? Hey, go out there, get those floaters, and you don't worry about the stable long-term debt. Now we're seeing the ramifications of that. It's the most aggressive tightening that we've seen since the 1980s, 300 basis points since March alone. Now, what does that do to an economy? What does that do to the residential real estate? Well, we see what it's done to residential real estate. All of a sudden, you go from 3% to over 6.5% to 7%. That basically has to slow things down. And if they'd done it a little bit more gradually, you wouldn't have gotten this shock effect right now. Certain markets are going to get pounded. Certain markets, a little bit less. If you're still in a market that's got high growth, people moving in, population decline. I mean, you got people leaving New York, about 800,000 people left New York in the last 2 years. Where are they going? They're going to North Carolina, South Carolina, Florida, Tennessee. Those markets aren't going to see as much of an impact because I think housing starts and the supply of housing is still not where it should be. So those markets aren't going to get hit as drastically as those that are losing, but you're still going to get price pullbacks, which you should.
Yeah. It was the worst year for stocks since 2008 as well.
What was that? How much were they down?
A lot. So, that's my headline right there. But honestly, I'm not in that space, but I know that worst year, I guess, in 14 years for the stock market. So
what do you do with that information? Do you continue to invest in stocks? Do you continue to look elsewhere? Do you continue to
Well, think about what it does for syndicators ultimately, because the people invest in stocks also invest in syndications. And 2021 and 2022 were a story of syndicators, sponsors getting flush with cash and feeling forced to spend the money. I'm not even saying invest. They were feeling forced to spend the money. So investors were giving their money to syndicators, and they were going out and placing it. What does that do to prices? Okay. Hockey stick, folks, drives prices through the roof because, keep it simple, supply and demand. All of a sudden, there's a high demand, so people are basically getting into a deal for a year, selling it for 30% gains, and the story was rolling, okay? And people were enjoying that. But that's come to an end now because those investors, they got crushed in the stock market, have pulled back their investments into real estate. Syndicators do not have as much money to place. And here we are now in 2023 in what I believe to be a buyer's market, and we're going all in.
Jake, in 2022, you can say it was almost a tale of two cities. The first half of the year, there was still a lot of optimism. Inflation at that time was still transitory. Things were still rocking and rolling. The second half, all of a sudden, we need to wake up and become adults and say there's something wrong with this market. We all knew crypto collapsed. A lot of the other financial instruments weren't working as well as they were a few months ago. And I think 2023, like Jake said, everyone who's listening to this, there's optimism if you're a long-term investor. There's optimism if you're a value-add investor. This is when you should be getting into the market right now, because as the market is going down and transitioning from a seller's market, really, the sellers had all the optimism, they had all the leverage. Now it's transitioning into a buyer's. And for those of you out there, there's one telltale sign. Have brokers been calling you back? Have they been cold calling you?
Gino calls me. He goes, he called me back. Oh, I couldn't believe it. I was like, you're like a 16-year-old girl getting a phone call back from the football player.
But when was the last time you got a call back from a broker, Jake? Let's be honest.
I never do. They hate me. I'm kidding.
How can they hate Stenziano? Come on, man. You bring the pain. You close the deals. You do what you're supposed to say you do.
We get them done. That's for sure.
But honestly, we even had a seller walk into our office a month ago. We got a 120 unit deal presented to us. That wasn't happening a year ago, because a year ago, the market was elevated and there was still jubilance and people thought, hey, it's not going to end. And by the way, if I sell my deal, where am I going to put the money? I don't have anywhere else to put it. Now the mentality is, holy crap, I better sell my deal before it goes down another 10,000
before it goes down even more, right? Yeah.
And that's the mentality. That's how you know things are shifting, because now all of a sudden you can have conversations. Now, I don't know when it's going to happen, but in 2023, there will be a point when sellers wake up and go, okay, I have to drop my prices because the brokers aren't calling me back to list my property. My property's been on the market for 6 months. It's way overpriced. They have to come. It's what we call.
Well, that's the thing. Brokers are saying no to sellers now because they don't think they can achieve the results they're asking for.
And brokers are smart in the fact that if it's a hot market, they know they're going to have multiple offers. If it's a cooling market and they overprice the asset, they're going to take the blame
wasting their time. They only have so many hours in the day.
And they don't look professional. And then they're going to go back to the seller and go, seller, I told you not to list it for $10 million. The seller's not going to remember that. He's just going to remember that the broker didn't get the deal done. So they're in a precarious situation right now. Ooh. And it's a lagging indicator right now. That's what happens. It just takes a little time to work itself through for the investors out there.
I like it.
Yeah, take your time and continue to reach out to the brokers, continue to create those relationships, because that's where you're going to stand out. Because when these deals come out and the broker has a deal, there isn't going to be as much demand. You're going to be able to get into the front of the line of that deal a lot quicker. And you're also going to be able to say, hey, rates are at 6% right now as opposed to 3% when we were looking a year ago. I think sellers are going to start to realize that they're going to have to adjust their pricing just based on the cost of capital going forward in 2023.
So again, those that took out aggressive bridge debt, probably a little freaked out right now. Okay. Probably a little freaked out. Cap rates are probably going up, right? We're seeing cap rates on the rise, which is, for me, as just wanted to buy, I love it. Last year deals were very challenging to find, especially ones that made sense. This year, I think we already seen it coming back. It cemented our view on long-termism. That's what 2022 did, because we saw this irrational exuberance come to an end. We're seeing things stabilize again. And for ourselves, 2021, 2022, it was painful not being able to participate in as many deals as we wanted to. But you can't be an idiot. You need to be patient and wait for your pitch. Sitting on the sidelines, it was frustrating, basically. But now, hey, we're back in it. We're rocking and rolling. Like Gino said, got 130 units under contract. Don't think 2023 is going to be your best bet to refi, but I think getting into 2024, there's going to be some opportunities. And also, be careful on your underwriting right now, okay? You cannot expect these 20% rent increases. If someone's drastically under market, that's one thing, but be very careful on thinking that you're going to raise market rents right now. And that gap between actual rents and market is where the money is going to be made if you can bridge it, okay? The other thing I want to touch on is there's been a lot of BS going around. Is it a recession? Is it not? Look, in 2022, there's 2 quarters of negative GDP growth. Okay. It's the worst stock market since 2008. I'm not going to get into some, finance debate, but look, there's a pullback. Let's be very clear. I know there's a lot of, silly discussions going on if we're in a recession. Well, I'm going to go the same route that these people go. Maybe I won't call it a recession. We're in a negative economy. I'm going to start making up my own terms, We're in a negative economy. The economy sucks and it's pulled back. Take that, Jack. That's what I'm saying. 2023, though, opportunity, baby. Let's roll. Gino, any final words?
Yeah, a couple of other things that we should mention. Vacancies are up. absorption is lowering. You know, the amount of assets that are coming online, they're not getting absorbed as quickly as they were. We really needed to take a look at the job market. What's going on in 2023? A lot of tech jobs were lost. So when you lose those white collar jobs, it really affects the blue collar jobs.
We need some maintenance workers, guys. If you stick at tech, come on over to the bright side.
And the last thing I like to end with is sales of multifamily decreased significantly in Q3 and Q4 of 2022 because of that expectation. I see that as rebounding in these next 12 months, because I think people who need to sell will sell. They have to sell. They just got to sell at a more, I don't want to say reasonable, at a more risk-adjusted basis price with the cost of capital being factored into it.
Gino, you the man. Gang, as always, we believe in buying deals for the long term. Think in decades. I'm Jake. He's the G Daddy, and we make it happen. We'll see you next time.